Okay, I can't believe the Fed just said this. And markets are like, oh, well, no big deal. Fed Waller says, I'm a bit more concerned about inflation running softer. So Fed Waller is concerned about inflation starting to run below the Fed's 2% target. He referenced in this clip that I will play to you in just a moment how if you really look at the 3-month or 6-month annualized rates of inflation, a lot of them are running at the 1% range and no longer above 2%, meaning that if we keep up this same pace of inflation, within a year, we could be well below 2%, and that's the larger issue. He also went on to say that companies are starting to tell the Fed that they don't have that pricing power, that people are starting to cut back and they're not willing to pay higher prices anymore. Now, why this is so crazy to me is we're getting sign after sign after sign of a hard landing coming, and Wall Street just doesn't care. Because, simply put, inflation is a cause. It's not an effect, it's a cause. Inflation is a causation of a strong economy. Deflation or low inflation is typically a cause of a weak or recessionary economy. Now, it doesn't always have to be that way. Like from 2008 through 2019, there was a lot of innovation and technology, a lot of deflationary forces at play. But in this current day and age, right now, you can't make that argument as much, okay? You can make that argument over a period of time, but when you get an inflation boom like we did in 2020, 2021, 2022, that was because the economy was doing really well. Now, as inflation starts to fall, it is a direct causation or correlation because the economy is weakening. So really, in long story short terms, the Fed's saying today, Fed Waller, that he's concerned about inflation actually starting to run below the Fed's target is the Fed saying they're concerned about the economy. It's like the workaround of actually saying we're afraid of the economy slowing down. Instead, they say we're afraid inflation is going to start running below target. It means the same thing, okay? And I do think the Fed is a little concerned because they cut rates 50 basis points and bond markets actually went lower on this. So yields went lower or higher, on the Fed cutting rates 50 basis points. I think the Fed wanted to accommodate markets a little bit more. I think Fed Waller today was trying to prop up bond markets, and to some degree, he did at least a little bit. TLT did start to move higher and yields did start to fall a little bit, but I don't think the Fed wanted the reaction that they got cutting rates 50 basis points on September 18th. Now, take a listen to this clip from Fed Waller on CNBC just within the last 45 minutes. It's titled, Waller says inflation softening faster than he expected, put him in the half-point cut camp.
Very pleased, Leslie and Carl, to bring you a special guest. We have with us from Washington, D.C., Chris Waller, the Federal Reserve Governor. Chris, thanks for joining us this morning.
Hey, Steve, thanks for having me on.
All right, well, great. I think I'm just going to start where everybody, I think, wants to know, which is, how did you get from a market pricing in 25 to eventually doing 50 basis points? And you obviously voted for this, so I'm guessing you supported it. Explain why you thought 50 was the right number this time.
Yeah, Steve, I think 50 really was the right number. As Chair Powell said in his press conference, we're at a point where the economy is strong, inflation is coming down, and we want to keep it that way. So we felt that 50 was the right policy action to do that. Now, on my own thinking, if you recall back in January, I gave a speech where I argued that if inflation continued to moderate at the pace it had been going, we could begin cutting rates and bring the rate down a fair bit just because inflation was falling and the economy was doing fine and there was no recession in sight. Now, we had a bit of a bump in the first quarter that pushed that back, but that's exactly the situation we're sitting in now. The economy's strong, inflation is coming down, and therefore it's time to cut. Now, in terms of 25 versus 50, when I gave a speech 2 weeks ago today, The data we had after the July jobs report signaled to me that cutting, say, 25 would have been a good idea. But I was open to the idea that we could front load if further data came in suggesting it. Well, the inflation data that we got during blackout pushed me in that direction for the following reasons. Everybody was focused on core CPI, but what they weren't doing was looking at how that CPI report and the next day's PPI report were going to feed into total and core PCE inflation. And once you did that, there's an estimate that August PCE monthly inflation will be somewhere around, say, 0.14, very low. If you take that estimate and you add it to the last 3 months of data on core PCE, that 4-month number annualizes to less than 1.8%. So over the last 4 months, if this estimate comes in correct, core PCE is running below our target. And that's with very high housing services inflation. We did a simple calculation, my team and I, that if housing inflation grew at 2% annualized and you plug that into the monthly numbers, core PCE would be running under 1% for the last 4 months. So that is what put me back a bit to say, wow, inflation is softening much faster than I thought it was going to. And that is what put me over the edge to say, look, I think 50 is the right thing to do.
It makes sense. I guess I did what you said I shouldn't do, which is I looked at that CPI number. I also looked at the market probabilities of an 85% probability of a 25, and I thought that the case is done, but I guess it was the PPI the next day and then the calculation beyond that. Chris, what's the right pace here, and how do we figure out what the right pace is? The market, I'm going to give you a fresh quote here, looks like it thinks you're going 50 again. Is that the right call?
Well, so first of all, I can think of several scenarios that determine the pace.
Chris, 25 for this time and 50 again in December is the probability now.
Right. So as Chair Powell said, he said this is really going to depend on the data. I can think of several scenarios that will determine the pace. So, for example, if the data comes in fine, nothing bad one way or the other, you could imagine going 25 at the next meeting or two. If the labor market data worsens or the inflation data continues to come in softer than everybody was expecting, then you could see going at a faster pace of possibly 50. And if the inflation data suddenly reverses, which, we've seen this before, it's not something new, you could even argue for maybe we should pause it. So there are scenarios in which you could do a number of things over the next couple of meetings. And that's why, as the Chair Powell said, we're really data dependent at this point.
But
and just the last point, I wish... Go ahead, Steve.
Sorry. No, you go ahead.
No, I was just going to say, the other thing I would just advise people is get off the calendar date. It's really a matter of what we do over the meetings, which includes January and March, but we don't put in a number for kind of January, March. So focusing on the calendar date, I think it's just a little bit misguided in terms of looking out. What you really want to think of is 6 to 12 months out, not just toward the end of this year.
So that's actually quite funny that CNBC cut off that clip before Fed Waller said he was specifically more concerned about lower inflation, because he was asked about the FedEx CEO's comments last night, where again, the FedEx CEO said, quote, "The magnitude of the Fed rate cuts yesterday signals the weakness of the current environment." And he was referring to the Federal Reserve's decision to cut interest rates by 0.5 percentage point on Wednesday. And he kind of spun it to say, no, the economy is not weak. Certain areas are a little on the weaker side, but just inflation starting to come down too much. Now, I actually did something very insightful last night, and I'm going to let you guys in on this little secret that I did. I read you guys in some of the last videos, the Beige Book, the overall economic activity, the summary of the Beige Book from the Fed districts. And the Beige Book is a report of how labor markets are doing, how the economy is doing, all these different aspects of essentially the United States, of all these Fed districts. And they do this every month. Okay, so I've read you guys this one, the most latest one that came out September 4th. I'm going to read it again, but then I'm also going to go back and read the Beige Book from September 7th of 2022. And it is bad, okay? This Beige Book is way worse than what we had in September of 2022. Now, I think that's interesting because back in, September of 2022, what was going on in markets at that time? It was a pretty bad period for markets. Okay, this is when you were on the downward descent to the lows that you hit in early October, where the S&P in total was down 27%, and Bloomberg was reporting a 100% chance of a recession. 100% chance, like with certainty, we were going to see a recession. Markets were down 27%. Let me just throw that in there again. Okay, so this is the latest Beige Book that we had, and I want to read this first to give you really the full picture before we go into the archive Beige Book. It says overall economic activity. Economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior month to 9 in the current month. So 66% of the economy is now in an active decline, and only a third of the economy essentially is in slight positive growth territory. It goes on to say employment levels were steady overall, though there were isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment levels through attrition. Still, reports of layoffs remained rare. On balance, wage growth was modest, while increases in non-labor input costs and selling prices ranged from slight to moderate. Consumer spending ticked down in most districts, having generally held steady during the prior reporting period. Auto sales continue to vary by district, with some noting increases in sales and others reporting slowing sales because of elevated interest rates and high vehicle prices. Manufacturing activity declined in most districts, and 2 districts noted that these declines were part of ongoing contractions in the sector. Residential construction and real estate activity were mixed, though most districts' reports indicated softer home sales. Likewise, reports on commercial construction and real estate activity were mixed. District contacts generally expected economic activity to remain stable or to improve somewhat in the coming months, though contacts in 3 districts anticipated slight declines. So the only thing positive in the latest Beige Book is this part on economic activity. Most contacts expected economic activity to remain stable or to improve somewhat in the coming months. This is because we all know the Fed is about to start cutting rates. Right? And did start cutting rates. That's why people think things will get a little bit better. Okay. Now let's read the September 2022 Beige Book and let me know what you think down below in the comment section. So this is the Fed Beige Book that came out September 7th, 2022. Again, as markets were down 27%, or did proceed to fall to negative 27% over the following couple of weeks after this Beige Book, and markets are pricing in a 100% chance of a recession. Get this. Overall economic activity. Economic activity was unchanged on balance since early July, with 5 districts reporting slight to modest growth. Okay, that's already better in activity, and 5 others reporting slight to modest softening. So not declines, but softening. Most districts reported steady consumer spending as households continued to trade down and to shift spending away from discretionary goods and towards food and other essential items. So, consumers steady. It's not what we heard in the latest Beige Book. Auto sales remain muted across most districts, reflecting limited inventories and elevated prices. Hospitality and tourism contacts highlighted overall solid leisure travel activity, with some reporting an uptick in business and group travel. We don't even get a report on hospitality anymore. Like, it's that bad. Okay. Going on, it says manufacturing activity grew in several districts. It didn't grow in any districts in the last month. Although there were some reports of declining output as supply chain disruptions and labor shortages continued to hamper production. Despite some reports of strong leasing activity, residential real estate conditions weakened noticeably as home sales fell in all 12 districts and residential construction remained constrained by input shortages. Commercial real estate activity softened, particularly demand for office space. Loan demand was mixed, while financial institutions reported generally strong demand for credit cards and commercial and industrial loans. Residential loan demand was weak amid elevated mortgage interest rates. Non-financial services firms experienced stable to slightly significantly higher demand. Demand for transportation services was mixed, and reports on agriculture conditions across reporting districts varied. While demand for energy products was robust, production remained constrained by supply chain bottlenecks for critical components. The outlook for future economic growth remained generally weak, with contacts noting expectations for further softening of demand over the next 6 to 12 months. Again, because the Fed was raising rates during this period in time. I mean, that's a wild comparison. When markets were down almost 30% and there was a 100% chance of a recession, the Beige Book was way better than it is today. And that's the disconnect I'm trying to get at here. Wall Street is just so dead set on this narrative that they refuse to see any red flags or dangers ahead. It's like, driving to a cliff where you're just looking up at the sky and we don't want to look at the road and we're just going to drive right off the cliff. Okay. Now, I don't know how much the economy is going to weaken. I don't know to the extent of the recession that we are going to experience, but the more and more and more signs of this has me more and more concerned, especially as markets just continue to be in Delulu land, hitting new all-time highs. So let me know what you think about that compare and contrast, if you will, analysis of the Beige Book from 2022 until today. Which one sounds better to you? With that said, today, markets are generally moving lower. You do also have 10-year treasury yields that are down almost 2 basis points today, which is actually what the Fed wants to see. And I think that's why Fed Waller went out today and showed, so much confidence that inflation is going to continue to fall and come in even lower than what the markets were expecting, because I don't think the Fed wanted to cut 50 basis points and have 10-year treasury yields rise to tighten financial conditions. I don't think that's what the Fed wanted. And, Waller went out on CNBC and essentially accomplished the short-term job that the Fed wanted to do, and that was lower 10-year treasury yield. So that is working at least a little bit today. Markets, though, still generally red. The Russell 2000 is the underperformer, down 0.61%. The NASDAQ is down 0.25%, S&P down 0.16%. The Dow is up 0.16%. So the Dow is actually positive today. What's fascinating here is the VIX is down 3%. So even though you're having this red day, hedge funds and institutions, they're taking off some of their hedges. So they're growing more confident in this market to stay elevated, to not fall, in other words, which is very fascinating considering all of the warning signs that we have for the economy. And again, don't let me scare you too much. I do think November, December, January, February, March of 2025, that is, those are going to be the rough periods. And I am expecting a 20-30% crash because I do think the economy is weakening a lot more than we think. But I do think the economic data is way behind. So the Fed, the government, all of these, firms, right? Or the BLS, I should say, they don't, there's no penalty for not being honest, right? The Fed is actually incentivized to lie to you when it makes sense to do so for their purposes of accomplishing their dual mandate. Never once will Powell lose his job for lying to markets, okay? They do this. That's part of the game plan. The Fed really has 3 mandates: maximum employment, stable prices, and lying to markets when they need to. But again, don't let me scare you too much, because I do think markets in the very short term over the next couple of weeks are probably going to go higher. And I do think there's an opportunity to play the upside in our markets, but don't be confused. There will be a lot of downside at some point over the next 3 to 6 months. And I tell you this now so you have time to prepare for this. So you have time to, save as much money as possible. Even if you have, let's say 3 months until we get a larger decline, if you could save an extra $100 a week, you're going to have $1,200 extra dollars to go shopping in markets when, we do see a larger decline. You could double that up. You could make $2,500, $2,400, pretty conservatively just by paying attention to what's happening out there. Nonetheless, today, the Fear and Greed Index is at 63. Yesterday, it was at 65. So not as greedy as we were yesterday, but you're almost dead set in the middle of greed. So this market, it could still get more greedy. It could still go higher, and that's my expectation in the near term. Markets are on a bit of a sugar high following that 50 basis point rate cut from the Fed. And we've seen the same thing happen in 2007 on September 18th, 2007. When you got a 50 basis point rate cut from the Fed, markets actually went higher, about 6.5% on the S&P, about 11% higher on the NASDAQ over the course of the following 3 weeks. Your latest AI investor sentiment survey kind of represents that as well. We've seen 11% jump in the amount of bullish investors on September 18th to 50.8% from 39.8%. So that's a big jump. Neutral investors fell from 29.3% to 22.8%, and bearish investors fell from 31.0% to 26.4%. So people are bullish. People are really jumping on this soft land bandwagon. You can see today the percent of stocks currently trading above their 50-day moving average is at 63.81%. You're down about 3.3% today, so 3.3% of all stocks are trading now below their 50-day moving average. That's not great, but it's also not terrible either. So let me know what you think about this information down below in the comment section. Are you bullish? Are you bearish in the near term? Are you under the assumption that I am? Do you think the economy is weakening and the Fed is late and these risks are not accurately priced into markets? And we will get a moment in time when the markets are forced to price in some of these recession risks. Like, I don't know if we're going to actually have a recession or not, but I do think the odds of a recession are a lot higher than the markets are assigning. The markets right now are saying there's a 0% chance, 0.00% chance of a recession. I think if those odds move up to 40 or 50%, which is more logical, that does constitute probably 20, 25, 30% downside from these current valuations. And unfortunately, I don't think the economic data is really that accurate. I don't think the Fed is being honest. So the only thing we have to go off of is corporate America and earnings, which earnings really start, to come in more about mid-October. And what we heard from FedEx did not sound good. And these companies' CEOs, they legally cannot lie to you or they will go to prison. Like, this is the only area of actual accountability and honesty that needs to be upheld. So I do think earnings season is going to tell us a lot more than the economic data. And if I'm wrong, if earnings season is great and companies do not have negative things to say, then that is what is going to make me a lot more bullish. It's not the Fed, it's not economic data or any of that. So that is it, ladies and gentlemen. Have a great rest of your day, and I will see you in the next one.